This is video lecture T7B on basis. Basis must be like tax rates. I just can't get enough. However, since basis helps taxpayers reduce their tax burden, it's pretty darn important. We start with Chew, who managed to buy stock for $100. A short time later, the price of the stock increased to $140. Even though Chew is going to receive $140, we know by now that Chew's income is not $140, but rather only $40. And this is thanks to the concept of basis. When we compute the gain, we are permitted to deduct our basis from the proceeds to calculate the gain, and the tax is only on the gain. But even though the gain is only $40, from a cash flow perspective, Chew receives $140 and pays tax of $6 to end up with $134. In a more complete computation, we would of course also consider the initial investment of $100 and also convert the cash flows to present value so we can net the outflows and inflows in different periods. Basis is adjusted over time when costs are recovered by different means, one of which is depreciation. If Herb places in service a machine that he depreciates over 2 years before selling it, the depreciation represents a recovery of his cost, and thus reduces his basis in the machine. The recovery lowers his basis in the machine so that when he sells it, his gain or loss reflects the amount of unrecovered investment, or basis, at the time of the sale. As much as we as taxpayers would love to be able to recover the cost twice, once through depreciation, and once through a cost recovery at sale, it's just not going to happen. As I've mentioned before, cost recovery deviates from cash flows. Typically, the cash is expended at the time of purchase, making the depreciation deductions a non-cash expense. Other forms of cost recovery might be more familiar. For example, the cost of inventory is typically recovered when the inventory is sold. Now that we understand the importance of basis, and we will gain an even greater appreciation of basis when we discuss partnerships in Module 4, how do we get basis? Typically, basis comes from an expenditure that has a long-lasting benefit. This means basis is often the cost of the item, but the rules are clear. It's the cost to get that property ready for its intended use, which means we capitalize the cost of the property and also additional charges, such as sales taxes, installation, testing, freight costs, etc. There are other bases for basis. Oh yeah, there are other bases for basis. For example, basis equals fair market value if the property is acquired through an exchange for goods or services. Borrowing money does not change how basis is derived. The tax law does not distinguish between property acquired solely for cash and property acquired with cash obtained through debt. Debt can be a good thing in the right circumstances. When debt is used to invest, this is often called leverage, and leverage can increase returns substantially. Let's consider Balik, who has two options. Number one, pay cash. Number two, borrow. When we analyze the returns in the pay cash scenario, Balik's return is based on the $1,000 return his investment of $10,000 is going to create. However, under the leverage strategy, because a smaller amount of Balik's money is at work, but the return is the same, Balik's return is much higher at 30%. In this way, Balik is using someone else's money to make money. Since he only has to share 5% of his return through interest, this works out very well indeed. The basis of inventory is a fairly complicated tax issue. Recall from your fundamental managerial accounting that finished goods inventory is a mashup of direct materials, direct labor, and overhead. It is the application of overhead between tax and typical financial accounting that generally differs. Much more overhead cost is allocated into inventory under the tax rules. That's really all you need to know about that. And it's also all you need to know about basis. Well, at least so far. This is the end of video T7B. Thanks for watching.